Good morning and welcome to the Coffee and Cap Rates podcast, your go-to source for New York City's latest commercial real estate insights. This program is brought to you by Ariel Property Advisors.
Hi, everyone. This is Shimon Shkury with Ariel Property Advisors, and we're here with Coffee and Cap Rates. And today, I have some fantastic guests for you. First, my partner, Victor Sozio. Vic, hi. How are you?
Hi, Shimon. I'm good. How are you?
Excellent. Happy to have this quarterly report about our multi-family asset class. And we also have Matthew Dzbanek here, our Senior Director in Capital Services. Matt, how you doing?
Hey, I'm great, Shimon. Thanks for having me. How are you?
Excellent. So let's get going. We're talking about the first quarter multifamily in 2026. The volume has been better by 7% compared to the year before. And we can tell you that we know that the multifamily market is bifurcated. We have the three categories: the free market category, the rent stabilized category, and lastly, affordable housing. And when you look at the free market category, you have seen increase in transactions. You have seen increase in values because rents have gone up so much. And you have seen a lot of activity, both from investors as well as lenders. That's exactly what we've seen in free market. But when it comes to other asset classes, it's a little bit different. And so, Vic, why don't you tell us what we've seen in the past quarter, in addition to what I just mentioned?
Yes, Shimon. So it's a little bit of a good news, bad news situation. As you alluded to, volume is up. We hit almost 2.4 billion, which is actually a healthy, robust multifamily quarter historically. And even when you look at the rent stabilized segment of the market, we hit over 650 million of volume in the first quarter, which is actually the most active quarter in that space since 2019. So since the changes in legislation. However, when you do a deeper dive into those numbers, of the 2.4 billion, a decent chunk of it, or at least a good amount of it, was the Pinnacle trade for 450 million. And in the Bronx and in Northern Manhattan as well, there were two other distressed type of situations that were a decent chunk of the rent stabilized value. So while volume is up, it does seem like a good portion of that activity relates to the distressed segment of the market, which is really no surprise given the pending maturities that we continue to face and the problems that owners are trying to solve for. However, I do view that as a positive, that lenders and borrowers are coming to the table more frequently to discuss workouts or pragmatic solutions for their assets. And in affordable housing, which accounted for about 10% of dollar volume and close to 6% of transaction volume. And that is pretty much in line or on par from previous quarters. So the market is more active.
We closed the deal earlier in the year, right? Why don't you tell us a little bit about
it? So there were five affordable transactions that occurred in the first quarter. Two of them were nonprofit transactions. Three of them were for-profit transactions. We were involved in two of those three for-profit transactions. One was an $80 million trade in Brooklyn, and one was a $9 million trade in the Bronx. The other for-profit transaction was a project-based Section 8 deal that sold to Jonathan Rose companies in Washington Heights. And a few things about this. The two that we traded is a continuation of the trend where buyers are stepping into existing capital stacks, which is extremely helpful given the fickle lending environment, which I'm sure that Matt Dzbanek here will touch on later here. The third asset, the project-based Section 8 asset, that remains the gold standard as it relates to affordable housing product, where it was a federally subsidized HAP contract, and that's actually a project where Jonathan Rose Companies is expected to put a ton of money into it. I'm hearing over 100,000 a unit to rehab and get a post-rehab markup to market, and also leveraging a new Article 11 tax benefit from the city.
Thank you. And I think in both of these transactions, with the exclusion of Jonathan Rose, it was mostly private investors that became a lot more sophisticated in the past few years buying affordable housing. Am I correct?
That's correct. And one of the things that we talk about a lot is part of it is there's opportunity in New York City. I think without question, given the fatigue really of existing owners and managing these assets. And what we're finding is that the private buyers, the private capital, not only have a longer term horizon to really weather the storm, right? The foreseeable near term future seems like it's going to be a little bit more of the same as it relates to regulatory concerns and compliance measures, et cetera. But the private groups in many cases also benefit from a more personal, direct self-management. And, we talk about it quite often is there is a ton of opportunity in New York City to get into these deals, especially where there's long-term accretive existing financing in place. But really it boils down to what can you reasonably expect to collect on the income side. And we're in a period of time in the past 5 years where economic vacancy has ballooned to really unprecedented levels where, it's frequently seen that 10 to 20% economic vacancy on this workforce housing product is really the norm. And these private groups, because they have a little bit more of a personal approach to the management, a little bit more direct engagement with their managers and the projects that they do feel like they can tighten this economic vacancy number and collect 90+% really, where if you are confident in your operations and feel like you can do that, I do think there are deals where we're offering, above 10% yield, cash on cash yield, if that's truly achievable.
Thank you. And it's interesting because you are mentioning the accretive debt. And the accretive debt, we have in the inventory right now about $500 million that's with accretive debt in different deals that are going through right now. And in many cases, it's a great advantage. But what happens when you don't have the accretive debt? Where are the lenders today? What do we see in that specific market? For example, we've seen some refinances in the past quarter. And I'd like, Matt, if you can tell us a little bit about where we see the lending market in deals that don't have accretive debt, in deals that needs to be purchased or refinanced as a standalone.
Yeah, 100%. So I would say the positive today is there is still financing available, right, for every asset class. Now, we've been using this term for a while, but I think it still holds true. It's still very much the tale of two cities. When you have a free market building in a decent location, there are countless banks, agency lenders, CMBS lenders that are going to want to compete on that. We're even starting to see the rise of the private credit funds. But when we shop out deals, we have in the range of 12 to 20 independent offers for predominantly free market, well-located assets. On the flip side, when we're running processes for rent stabilized deals, we're seeing a lot less. We still have the agency and CMBS players who are looking at these. I will say the banks are really where we start to see a drop off, and depending on the amount of stabilized, depending on the location, and then I would say the other two major items are violations and collections, really determine how lenders are looking at these deals. So the first question we always get when we're looking at sort of deals in certain locations is, how are the violations, how are collections? And that'll help us dictate how things like this get done. We're also seeing, on the construction side, a ton of interest. Every development deal we have lists of lenders who are just trying to get active in that space. They see it as a very attractive place to be in New York without any regulation or government interference around them. And there's a real lack of supply. So I think you're going to see a lot more specifically condo construction and hopefully more rental construction in the near future as supply-demand economics continue to tighten.
Yeah, the supply and demand economics, as you mentioned just now, are very interesting because they do push the rental fundamentals up consistently over the past 6 years. We've seen that. In addition, the fact that you have many vacant apartments in the rent stabilized category, shadow apartments that don't get rented, is definitely weighing into stronger rental fundamentals for the free market world. Let's wrap this up. We do see that maturity walls are coming. We know that in 2021 and 2021-22 vintage is about to mature, and we're seeing that in different transactions. Before we wrap up, Vic and then Matt, anything else of what we should expect for the balance of the year in terms of multifamily?
So, and we see it in our current pipeline, both on what's on the market and what's under contract. It seems like there is a lot of activity. There's a lot of motivation, both on the sell side and the buy side. It really just becomes more a matter of navigating through the continued volatility in our markets, continued elevated interest rates. So it's really just a matter of bridging that gap between seller and buyer and oftentimes lender. But I expect activity will remain pretty much status quo for the rest of 2026. And hopefully that means, $2 billion a quarter in multifamily dollar volume. And, that's the hope.
Thank you. And Matt, anything else to wrap this up?
Assuming macroeconomic fluctuations stay fairly flat and treasuries don't see major movement, I expect second half of this year to be very strong on the financing side. I think you're seeing renewed interest in borrowers looking to do something. You're seeing renewed interest in lenders looking to put money to work. And I expect that to continue to get more attractive as time goes on.
Thank you. So more people are meeting the market, both buyers and sellers, and more liquidity. And that concludes our coffee and cap rates. Thank you so much for listening.